Hello, everyone. This webinar is brought to you by Saturn Advice, and welcome. So my name is Joyce, a financial advisor at Saturn. Thank you for joining us for what I believe is going to be a really timely and insightful session. Now, since Trump's Liberation Day, markets being on a roller coaster, we saw a sharp dip and then a snapback rally. Today, we are here to talk about what's really going on in the world, what's the implication for US and the rest of the world, and what does it mean for investors. Now, you might be wondering, who is this person here? So we are bringing one of the best voices in the investment business to help us make sense of it all. Our special guest today is Alex Cousley. Hi, Alex.
Hi,
welcome.
Thanks, Joyce. Thank you for having me.
I know you are very busy, so thank you for making time for us. As a way of introduction, so Alex is a senior investment strategist at Russell Investments, and he also leads their global equity strategy research team. At Saturn, we use Russell Investments' Sustainable Global Shares Fund in our model portfolio as a core strategy for international shares exposure. All right, so let's go straight into it. Let me share your slides. Alex, I've got a loaded question for you. President Trump's on again and off again tariff policy is coming out of White House or social media on a week-to-week basis. Can you unpack for us what's actually happening? And investors are asking, is this a start of something big, such as deglobalization? And what this could mean for the US economy? Are we in the verge of a recession?
Okay, that is a very loaded question. So in terms of what is happening right now, so if you go back to November of last year, Trump has 4 policies that we thought the market and investors should focus on. On the positive side, we had lower taxes and deregulation. On the negative side, it was all about deportation or less immigration and tariffs. And the market was really focused on the positive side for the first 2 months of his presidency. Then we came into 2025 and tariffs became a bigger focus. On Liberation Day, when we got the announcement of the tariffs, we ended up seeing China sitting incrementally about 130% tariff. The dirty secret of tariffs is anything above 35% effectively stops trade. It's too expensive. It's too hard to do. What we were worried about on Liberation Day, and it's becoming less worrying, is if Trump is going after everyone, that's a really big challenge, because one of the things that's become quite apparent in the last 10 years is because trade is so fluid and the global economy is so interconnected, when you have tariffs on one country, you're able to avoid some of those tariffs. So China did this quite nicely in 2017. If he goes against everyone, that's a really big hit. What we've seen thus far, I think, reinforces the view that many people had coming into this, that this is largely negotiations. This is a negotiation tactic. Trump has got this style of negotiations where he goes extremely aggressively and pulls back, and we've seen some pretty meaningful pullbacks. So what does it mean for the US, for deglobalization? I think the idea of deglobalization marginally is correct. So we've probably peaked in terms of globalization. We peaked in 2009, 2010. We've been gradually moving lower. And I think that is probably the direction of travel, but this worry about very fast and severe deglobalization is probably unlikely. There is a very strong reason why a lot of trade happens within Asia. Supply chains are all within Asia. You can't pull one part out and move it to the United States. It becomes prohibitively expensive. So incrementally, a little bit less globalization, but the economy is still going to be very interconnected. Is the US going to hit recession? We think it's more likely to avoid it. So economists love talking about recession risk. It's a big topic du jour. And one of the rules of thumb, whenever you hear someone talk about recession risk, if you don't know anything and you're just kind of guessing, you should think about 15 to 20%. That's the rough normal recession risk that you would see in an economy. As you can see here, we think it's kind of 40%, maybe even a little bit down from this 35%, somewhere in that ballpark. So above average, but not base case. And so I think from that perspective, we are in an environment where growth is going to be slower. Inflation is going to have this 1-year pickup in the United States on the back of some of these tariffs if they eventuate. But the worst fears have probably been reduced as Trump has backed down on some of these tariffs.
Yeah, and it sounds like on the Liberation Day, there is a mismatch of expectation and reality, and then the investor panic. And when investor panic, we tend to go to that dark places and then overcorrect ourselves. That's where the mispricing appears in the market.
Yeah, exactly right. And if you go to the next slide, so yeah, what we have here, so when markets are moving really quickly, it's very hard to get a sense of exactly what people are pricing in terms of economic outlooks or earnings outlooks. So what we've done here is this chart goes back or uses data all the way back to 1850 in the US and looks at what you normally see when during a recession, a cyclical recession. So that gray line there is the normal drawdown. So you see about 30% top to bottom during recession. So what we did is we used this as our ballpark to get a sense of what recession pricing is happening in the market as markets are moving fluidly. And so on April 4th, the market fell 4.5%. April 7th, which was a Monday, the US market opened up another 5% down in futures. And at that point, the market was really pricing basically a 70% chance of recession, which is very elevated. And so within our multi-asset portfolios, and we have a sentiment slide later on, but we thought that actually leaning into this sign of panic is generally a better environment than, is a better approach than trying to sell out and starting to panic along with the crowd.
Or just show the sentiment slide that you mentioned earlier.
Perfect. Yeah. So this is a proprietary indicator. We built this in 2018. And what it does is behind this one line is about 18 different variables or different indicators. And we use statistics to get the common trend. So what is the common trend amongst all of them? And it does a really nice job of telling us when markets are hitting panic. So when you see that line, the black line going up through the orange line, effectively this is times when markets are really showing signs of stress and signs of panic. And there's that classic phrase, when everyone is when everyone is very scared, you should be greedy, and when everyone is very greedy, you should be scared. And this is basically a mathematical format of that. So we started seeing signs that panic was coming through. And that was our sign to just incrementally start adding a bit more risk to portfolios because your forward returns are starting to improve.
Yeah, absolutely. And that shows the value of having active managers in your portfolio because active fund managers are able to, instead of blindly follow or mechanically rather follow an index, you are able to identify this mispricing. Be greedy when you invest, when most of the people are fearful, adding to these positions so that the portfolio is well positioned for recovery and future growth.
Correct. Yeah.
Yeah. And also just for the audience, I just want to mention the reason that we spend a lot of time on US is because US is the largest and most liquid financial markets in the world. As it stands now, it probably still make up about 66% of the world's capital market for equities. That's why we, whenever you dial into a market commentary call, we always talk so much about US. All right, so moving on to the next question. So over the last, I think over the last few years, from an investor's perspective, it feels like the market are really erratic. And Alex, how much of what we are seeing is driven by real hard economic data, and how much is just reacting to the unpredictability of the current US administration?
It's a really good question. So there are some dynamics that might be driving more fast-moving flavors in the United States, especially in pockets where you have a lot of retail money and some of these kind of dynamics. But the key question, so the hard data, so the economic data for the last 12 months has generally been better than expected. In the US, it's been becoming the case in Europe, it's been becoming the case in China. What we are doing right now, though, what we're seeing right now is there's a really big tension. So economists talk about hard data and soft data. So hard data is spending, it's jobs, it's capital expenditure. The soft data is surveys. So how are people feeling? Do they think the economy is good? Do they think the economy is bad? And the soft data has crumbled. So the chart on the right here, this comes from Goldman Sachs, an investment bank. And you can see on the right, the soft data for current expectations and for current conditions has plummeted. So that red line and that gray line have completely fallen. And the hard data, which is that light blue line at the top, has held up really nicely. And what everyone is wondering and worrying about or thinking about is these two at some point should converge and come back together. And the question mark right now is, will the hard data catch down and fall, or will the soft data catch up? And since this chart was done, we have seen early signs that the soft data is actually picking up. So some of the US consumer confidence numbers, people are starting to feel a little bit better. And I imagine it's very much because the worst of tariffs appear to have been behind us.
Mm-hmm. Yeah, that's reassuring. While we don't have the crystal ball, it's reassuring to hear that there is signs that soft data is catching up to the hard data.
Yes, yeah. And I think the last bit, just on that soft data, that people we worry about as economists and people that follow markets is the reason that the conditions or expectations are worrying is if everyone thinks that the economy is really bad, then you stop spending, or that incremental dinner out that you're going to go for, you don't go and you save the money. And by saving the money, that's someone else's income that you've now not spent. So you have that person's lost their income for that particular item, and that has a cascading effect. That's what we are very carefully monitoring, and thankfully, so far, we haven't really seen any signs of that.
That's great. Alex, my next question is about market concentration. So over the last 3 years, investors hear a lot about market concentration and Magnificent Seven. Looking at these two charts, can you walk us through what's going on here and what it means for a diversified investor?
Yeah, absolutely. So the Magnificent Seven are the big tech names. So NVIDIA, Microsoft, Apple, Amazon, what else is there? Google. There's one more. But they have had a cracker over 2023 and 2024. So if you look on the chart on the left, this was, the orange line is the Magnificent Seven, and it effectively was a rocket ship. It just kept going up and up and up. And it was really driven by the fact that, one, the corporate profit fundamentals were pretty solid, especially for a company like NVIDIA, which makes chips for AI. And the second was, AI as a thematic was really the dominant driver in markets. That was what everyone was focused on. You can see on the gray line, this is effectively the US equity market minus those big names. And it really didn't do much. But what we saw at the start of the year, actually it started early, it started in December, is that we started to see some cracks coming through in that Magnificent Seven. And this is where I think active management and diversification really play a nice role. The average active manager tends to be slightly underweight those names because they're generally a bit more expensive and is overweight the rest of the market. And that really played out quite nicely as those names saw some selling. The other bit of diversification that I don't think anyone had on their bingo card for the start of Donald Trump's presidency is on the chart on the right here, we have USA in blue, EFI. So EFI is developed markets excluding the United States. So it is Europe, it is Japan, it is Australia. And it had a really big catch up. So you can see that gap between blue and orange really closed. So non-US markets did quite well. And then the gray line is emerging markets. And you can see there that China in particular saw that big rebound coming through. And China did really, really well over the period from December through to March. And so, it was a very interesting period where coming into November when Trump won the election, the Trump trades, everyone was talking about Trump trades. And it was long US dollar, long US equities, long small cap equities in the United States, short China, short Europe, long Bitcoin. All 7 of those trades haven't done particularly well. And this comes back a little bit, Joyce, to the sentiment piece, that there was a lot of excitement and a lot of enthusiasm for those. And so small changes or small disappointments lead to bigger reactions. In the case of China, small data points that are better than expected have a big impact because everyone has been so negative.
Yeah. It reminds me, someone once said, when it comes to investing, being better or worse is more important than being good or bad. And I think, in my experience of working as a financial advisor, I've seen too often a top performing asset class this year become the worst performing asset class the following year. So when we build portfolio, we don't think about picking the best performer in any given year. It's about investing people's money responsibly and make sure they don't get obliterated in any given year so they stay in the game.
Absolutely, yes.
All right. I want to shift our focus to bonds a little bit. Bonds used to be the go-to safe haven when share market dropped. But in the last 5 years, this relationship hasn't been that reliable. So Alex, I would like to get your insights. What do you think is caused the switch on and switch off correlation? And is the diversification benefit of bonds broken?
It's a great question, and it's been a very common refrain in markets that government bonds have broken their role as a diversifier. So the chart we have here is the 90-day correlation of US equities to US 10-year bonds. You can do it for other regions. It looks very similar. The crux of a standard 60-40 portfolio, if you did the very basic 60% in equities, 40% in bonds, the crux of that is that this is negative. So when equities are doing very well, bonds aren't doing particularly well, and vice versa. And the vice versa is much more important when equities are selling off, bonds are doing well. And you can see that pretty reliably from 2001 through to 2022. It was negative, pretty firmly negative. 2022 comes along. What happened in 2022? Effectively, inflation was stronger than people had expected, and it was more persistent than people had expected. So the Federal Reserve and other central banks had a very famous, saying transitory inflation. We're going up and we're coming straight back down. We did come back down. It just took longer than anyone had actually expected. When you have those inflation surprises, they're bad for government bonds because government bond prices have an inflation expectation built into them. And so when inflation is higher than expected, you get a drag on your capital gain or the price of the bond. And it's generally bad for equities as well because it's likely going to be a drag on profit margins. And that's why you get this positive correlation. What we've done is we've kind of been moving up and down. We've kind of been positive, negative, positive, negative. What is really important to note, though, I think, is when we've had moments where growth has been the dominant driver, we have seen government bonds play their role as a diversifier. And I can give you, there's 3 big examples. The first was Silicon Valley Bank, which was a big US bank that went bankrupt in 2023, and government bonds rallied a lot on the back of that. The second was a little bit weirder, but in 2024, the Bank of Japan raised interest rates at the end of July. They hadn't raised rates for 25 years, maybe longer. And then the US employment report was weaker than expected. Government bonds had a really strong rally then. And even during the trade tensions, and trade is an interesting one because it is tariffs are for the US, inflationary in one year because prices are going to go up, and growth negative because effectively it's a tax. And when we've seen days when other countries have responded to the US, particularly China, we've seen government bonds play their role as a diversifier in portfolios. And so even amongst periods when it's very messy, when we've had the big focus on growth, we have seen government bonds play their role. And so as we look forward, we have, firstly, we think that government bonds are pretty attractively valued. So they have a role in the portfolio. And that more importantly, if we hit that air pocket, so that 40% recession risk, if that's actually 80% and we're heading into recession, we think the government bonds have a really nice role to play still in the portfolio. And that diversification benefit hasn't been broken.
Great, thank you. Moving on from that, let's zoom in on New Zealand for a moment. New Zealand being a small economy, we are quite impacted by what's happening overseas. So Alex, what kind of ripple effect could these global trade tension have for us Kiwi here at home?
So the Kiwis are in the same boat effectively as the Australians. We're 2 ships in the same sea. There is one big difference for the US versus Australia and New Zealand. Actually, this applies to a lot of other countries as well. So there is ripple effects, particularly from China. China is a big market for New Zealand. It is a big market for Australia. So if China has softer growth, that will flow through to New Zealand and Australia. The second thing is, and this is where it's a little bit different, is, so I talked about in the US, we are going to see 1-year inflation go higher because there is going to be tariffs on goods. In Australia, in New Zealand, in some parts of Asia, what you're likely to see is actually downside pressure on inflation because effectively, if you're an exporter to the United States, you have 2 options. You can see a much lower demand because the price has gone up, say 30% on a tariff, or you can offer discounts and reduce your price so the end consumer doesn't face 30% increases. Another approach is that you find a different market that you can sell to closer to market price. That's where Australia and New Zealand kind of come in. High income countries, decent populations, nowhere near what the size of the US is, but they're big. And so what you're likely to see is, especially on some durable goods, clothing, etc., is that you're going to see some cheaper goods coming to the shore as countries look to diversify their exports. And so it's where there is very little tension for the RBNZ relative to the Federal Reserve, the central bank in the US. And so we think that they just cut rates 2 hours ago, and we suspect that they're probably going to land around that 2.75 to 3% over the next 12 months. So 1 to 2 more rate cuts. So we're below where they think neutral is. So they're actually providing support to the economy now, and there's probably a little bit more room for more support. And I think everyone is very carefully watching the ripple effects of what is happening in China. If Chinese growth does hit a bigger air pocket, there's probably more room for interest rates to come down. So obviously that's very important for mortgage holders.
Yeah.
And it's also important for the consumer because there is a lot of follow through from cash rates to consumption in New Zealand, and similar to Australia, It's a little bit different in the United States because they have 30-year fixed rate mortgages.
Mm.
So what happens with the Fed, or their central bank, doesn't really matter to the same extent. Whereas New Zealand, Australia, it's much more variable. And so, each incremental rate cut is extra income in the pocket of consumers that can then be spent or saved.
Right. So basically, we can expect possibly cheaper durable goods, lower mortgage rate, so hopefully more discretionary income, more money in the pocket. And for savers, unfortunately, there will be lower term deposit rates and less cash income.
Correct, yes.
What about currencies? What about its impact on New Zealand dollar?
So it's probably, I think, most likely to move sort of slightly flat over the next little while. There's still a lot of volatility in currency markets. If you extend your horizon out towards the end of the year, maybe a little bit beyond that, you probably see a little bit of upside. I think the upside will be limited relative to Australia. So I think against the Aussie, we'll probably see New Zealand dollar fall a little bit, but against the US dollar, I think you see a bit of upside there.
Okay. Yeah. So slightly less expensive overseas holidays, hopefully.
Correct. Yes.
That's great. Now we are wrapping up the webinar with this colorful chart here. For the audience that's getting a little bit impatient, we are almost there. So Alex, can you talk us through what this chart is really showing? And what is your parting message for investors wondering how they should feel right now looking into the future?
Absolutely. So this chart, it's a little bit messy, but if you stick with me for 2 minutes, the orange dots show you the drawdown that you experience or the pullback you experience each year. So in 2024, we saw a 9% pullback in equities top to bottom. The blue line or the blue bars show you the end of year performance. So I think it's really important to remember is that pullbacks are often temporary. You see sometimes big ones. It's very notable that the average pullback was 16% over this time horizon, but in only 6 of the years did you actually see the market end up in negative territory. The data looks fairly similar for New Zealand and for Australia as this. And so, for those that have longer term horizons, it's a really important reminder to stay invested. And if you have spare cash, you have the opportunity to add to risk during these moments. It tends to be a good strategy over a longer period of time. I think the parting message is, I think that we have probably been through the worst of the volatility for now. If you are a long-term investor, stay the course, stick close to your strategic asset allocation or your plan that you have. And I think the last bit is, diversification works. It has worked for a very long time. It will continue to work, both within the growth portfolio. So, not taking massive tactical or regional bets, and also, relying on some defensive levers such as government bonds or commodities as your diversify is a very good strategy.
Love it. So diversification still works and growth is not linear, but the long-term trend remains. Fantastic. Yes. Yeah. Well, thank you, Alex, for cutting through the noises and help us see the bigger picture. And really appreciate you parting your knowledge and experience here with us. And I also want to leave our audience with one simple message, that is, have a plan. Confidence doesn't come from knowing exactly what's around the corner. None of us has a crystal ball, but confidence comes from knowing you've worked through different scenarios, you have set the right foundation and made decisions aligned with your circumstances and your life. So thanks everyone for tuning in. If today's session has sparked any question about your own investment, please know that you don't need to navigate this alone. Reach out and let us help you. Thanks everyone. And thank you, Alex. I look forward to the next conversation with you.
Thank you very much, Joy. I appreciate it.